Hello, we're looking today at capital gains and other sales. That's the name of the chapter. We're really focused in this video on capital gains from a tax standpoint. One of the things we have to figure out first is what type of property we have, because the type of property we sell will determine whether we have capital gains at one rate or capital gains or losses at another rate. So the type of property, like you'll see 1221 on the property I'm going to talk about now, refers to an Internal Revenue code section. So in this case, there's section 1221 property. And this section defines a home, and that's obvious, often a residence of the taxpayer. It calls a car 1221 property. That's for personal use. Expensive personal items, there's the car listed again, but also things like furnishings or collections, like stamp or art collection. 1231 property could include that same type of stuff or other stuff if it's used for business and not for personal use. One of the most important things to do when you're considering capital gains is determine whether you have a short-term or a long-term gain or loss. So the definition in the tax code is pretty common. Short-term gain or loss is held, is an item that you've held and are now selling for only 1 year or less. So for example, if you bought something 11 months ago and you're selling it now, it's short-term. Long-term capital gains and losses are for items held more than 1 year. Look at this slide showing how complicated the capital gains rates are. They're really a lot to get your hands around. Notice that they're always lower than the taxpayer's regular bracket. So there might be a 0% capital gain rate if you sell a capital item if you're in a tax bracket that's 15% or lower. Generally speaking, that means a person who kind of has low to moderate income. Separate that from low or moderate wealth. It's not necessarily the same thing, but low or moderate income. So then taxpayers that have moderate to upper income and are taxed at 25%, 28%, 33%, or 35% find their capital gains taxed at 15%. Taxpayers who have a lot of income, more than $406,750 for a single taxpayer, more than $457,600 for a married filing joint taxpayer, more than $432,000 for a head of household taxpayer, find that their capital gains are taxed at 20%. For depreciable real property, the capital gains rate is 25%. And for collectibles, it's 28%. Now, these rates also vary depending on whether they're short or long term. One exercise you always have to go through when you're trying to determine the tax on your capital gains is you net short-term and long-term items. So first you net all the short-term items, then you net the long-term items, then you combine the short-term with the long-term. And some peculiarities here happen. Keep in mind the general rule is that short-term gains are taxed higher than long-term gains. So sometimes you actually might be able to net short-term losses against long-term gains and find that you're taxed less at the long-term gain rate. Everything moves toward, if we can, isolating short-term capital gains and taxing those higher than anything else. Also, losses of all types are limited, and you can see that in your textbook. So you can't just have an unlimited deduction for capital losses, be they short-term or long-term. Let's go through an example. And every example is different. So this example shows you how to handle these 4 items. Please consult your textbook or contact me if you have questions about other items. So here we're looking at several transactions that Billy Boy did with capital assets over the year. We can assume that all of these are 1221 assets. They're personal use type things. So first, Billy Boy has Town Bank stock that he purchased on December 1st, 2013 and sold 9 months later or 10 months later on, and it's actually 9 months here, on September 1st, 2014. Billy Boy sold items for a total of $15,000, sold stocks for $15,000. His basis in them was $9,000. So his gain here is $6,000 and it's a short-term capital gain. The CSX stock, Billy Boy also purchased on December 1st, 2013. He sold this a mere 4 months later on April 1st, 2014. His basis was $17,000 for these. His sale price was $17,000. Basis was $25,000. So he actually lost $8,000 here. And this is also a short-term loss in this case because the items were held for less than a year. Billy Boy also sold some BP stock. Now look carefully at this. This stock was purchased on June 5th, 2012 and sold on December 5th, 2014. So this is long-term stock. And the sale price was $38,000. The basis was $20,000. So Billy Boy actually had an $18,000 long-term gain. And then Billy Boy sold a vinyl record collection. And Billy Boy bought the collection on January 1st, 2013, sold it 13 months later on August 1st, 2014. The sale price was $20,000. The basis was $14,000. That made the gain $6,000. Vinyl record collection that sells for this kind of money would be things like original Elvis Presley records, original Beatles records, probably some old blues, and so on. Before I leave and we actually start to analyze the tax on these, let me say something about basis, which I've marked here with a B. Basis derives its name from cost basis, but cost basis and basis are slightly different. Cost basis is what you actually paid for something. So for example, the Town Bank stock may well have been a $9,000 actual payment for the stock on December 1st, 2013. But basis is not necessarily cost basis. Let me give you an example of how it might not be. If Billy Boy's father left him the stock on December 1st, 2013, and it was worth $9,000 then, but really his father bought it in 1990 or 1995 and maybe only paid $1,000. Billy Boy was allowed to do what's called a step up. Now, a step up is something we'll talk about other places within the chapter, but what happens here is Billy Boy, even though his father only paid $1,000, is allowed to step up to $9,000, the value of the stock on the date his father died. But notice this is not what his father paid. So in the example I'm describing, it would still be basis. Billy's allowed to act as if he paid $9,000, but it's not cost basis because it's not what he really paid. Let's spend a few minutes analyzing what happened here as a result of the netting process that we did and the different types of sales that were done. First, there were 2 short-term sales. One was the CSX stock, which sold at an $8,000 short-term capital loss. And then there was the Town stock that sold at a $6,000 capital gain. These 2 are netted, and they're netted to a short-term capital loss of $2,000. Remember I said earlier that we would like to net these since they're a loss against long-term capital gain. And we actually can do that because next we have the long-term BP stock at an $18,000 long-term capital gain. That NT cap gain you see there probably should say LT capital gain. So we have $18,000 from that. On the record collection, which is going to be taxed differently, there's a $6,000 gain. So let's look at actually what happens for tax purposes. Billy Boy's record collection is taxed at a high 28% rate, his regular rate, at $6,000, offset by a $2,000 short-term loss. So he gets to pick up that loss and apply it against the high rate, the high gain, comes up to $4,000 and multiplies the $4,000 by 28%. That turns out to be $1,120 in tax that Billy Boy owes. Then the $18,000 long-term capital gain is taxed at a 15% rate. Because Billy Boy was in the 28% rate, if you remember that slide a few slides back that said your regular rate's 28, so your long-term rate's 15%, he actually winds up paying $2,700 on the long-term capital gain, 18,000 times 15%. And then when you add the two taxes together, the 1,120 and the 2,700, he's actually going to pay $3,820 in tax just from capital gains. This will show up in one line on his return, and then on other lines on the return, we'll see taxes for other things. Well, I hope you found the video helpful and useful. Give me a call if you have any questions. Take care.